Good morning, everyone, and a very warm welcome to today's webinar, the final part in our industrial policy series, hosted by the International Economic Partnership Program. My name is Margot G, and I'm ERSA's podcast host. The IEP program is a UK-funded program working with the South African government across three thematic areas: fiscal reforms, structural reforms, and macroeconomic coordination. The program also focuses on capacity building, gender mainstreaming, and contributions to G20 activities. It is a pleasure to be with you here today as we explore one of the most pressing and complex challenges in South Africa's industrial landscape: how to mobilize finance that is not only available, but catalytic for sustainable and inclusive growth. We will critically examine the effectiveness of South Africa's development finance architecture in supporting industrial policy objectives, while also identify forward-looking reforms informed by international experience and comparative best practice. If you're interested in watching the previous webinars, they can be found on ERSA's website and YouTube channel. We will share the links in the chat. Also, at the end of today's webinar, we will also be sharing a feedback survey. Please give us 2 more minutes of your time as your experience matters to us. We definitely take it into consideration. Today's webinar is an important one. The number of DFIs in Africa have increased significantly over the past 10 years, ultimately aiming to make finance more accessible. When we consider the progress on the UN Sustainable Development Goals ahead of the G20 summit, there is much progress that still needs to be done. At the same time, industrial policy has re-emerged at the center of global economic debates as countries rethink how finance can actively shape industrial transformation, technological advancement, and the green transition. In South Africa, development finance institutions like the IDC, DBSA, and others play a critical role in driving this agenda. But questions remain. How effectively are they mobilizing capital for investment and innovation? Are our financial instruments aligned with the scale and urgency of our industrial ambitions? And how can we leverage domestic savings to fuel structural transformation? Today's discussion draws inspirations from a fascinating paper by Professor Andreoni and Adria Rius, entitled From Dormant to Catalytic: Mobilizing Domestic Resources for Structural Transformation by Connecting Public Institutional Investors with Development Finance Institutions in Africa. Their research examines how African countries can finance their own structural transformation sustainably and with less dependence on foreign capital. To unpack these issues, we have an exceptional panel joining us today. Their full bios are available on the ERSA website, so I will introduce them fairly briefly. First up, we will have Professor Andreoni, Professor of Development Economics at SOAS, Center for Sustainable Structural Transformation, and one of the world's leading thinkers on industrial policy. Adria Rius, his co-author and researcher at SOAS, who has been analyzing the data behind the institutional linkages. Pamela Mondliwa, Head of Research at the Industrial Development Corporation, the IDC, bringing the perspective of South Africa's leading development finance institution. Annie Sugrue, a familiar face on this webinar series, Director at ERSA Developments with deep expertise in sustainability, women's economic empowerment, and small business development. Diana Smallridge, President of Momentous Global, an internationally recognized advisor on development finance reform and DFI governance. Last but not least, Professor Michael Jacobs from the University of Sheffield, an environmental and political economist whose work bridges macroeconomics, finance, and the climate transition. Together, we will examine how South Africa's development finance architecture can better support industrial transformation through strong institutional coordination, smarter financial instruments, and more inclusive outcomes. It is my absolute privilege to introduce Professor Andreoni, an internationally recognized scholar in development economics and structural transformation. His work traverses industrial ecosystems, institutional design, and green finance, making him ideally positioned to lead our discussion today. So, without further ado, Professor Andreoni, over to you.
Thanks, Margot. Thanks so much for the kind words and introduction. It's a great pleasure to engage you in this discussion. We thought it was useful to frame some of the conversation building on some of the ongoing work at the Center for Sustainable Structural Transformation, This is a center based at SOAS University of London, which has been working over the last 2 years in building up an agenda for structural transformation across the continent, but of course, with a specific focus on a number of countries and regions within the continent. South Africa is one of the countries where for many years we've been working with partners, both in academia and institutions. So I'm happy to share some of the ongoing work, and I invite you all to check on our website some of the material we cut across not just development finance, but also broader industrial policy issues, from issues related to critical minerals to energy transition, infrastructure, and engagement between the state and broader stakeholders, in particular the private sector. We're going to share a few slides. Adria, if you could share the screen, I will be happy to start. The presentation we're giving, it's really trying to, as I said, set the scene of the conversation. And we have chosen this title of Reframing Developmental Financing Function within Industrial Policymaking. The title really emphasized that when we think about development finance, we're thinking about a very critical function within an industrial policy mix, an industrial policy package of intervention. Development financing itself, it's not the silver bullet for addressing everything, but of course is a key ingredient in industrial policy making. Next slide. Now, if we think about the context of the discussion, and just to keep in mind how problematic is at the moment the situation across the continent, starting from the South African context. Most of the countries across the continent have suffered from decades of underinvestment and deindustrialization, in some cases premature deindustrialization. When you look at South Africa in particular, with a number of middle-income comparators, you can see that fundamentally the GDP growth has suffered from an industrial structure which is struggling to add value, to perform in terms of export, and also to drive technological change, and in particular a broader restructuring of the economy, so in terms of its diversification and in terms of its broader investment. Now, the investment figures, so the capacity of creating fixed capital formation and more broadly directing resources towards productive investment activities, is also made complicated by the fact that despite the emergence, for example, in the case of South Africa, of a very large stock market and sophisticated stock market, these institutions are not capable to translate actually the resources that have been in the stock market into productive investment. South Africa is a country which has suffered from dramatic financialization, and we've done specific work on a number of firms, large OEMs and large players that have shown this kind of pattern. Now, of course, the picture is now made even more complicated by the fact that there has been, over the last few months, a significant amount of concern around the extent to which countries which paradoxically in the African continent have done relatively better in terms of building their manufacturing base. There has been an increasing concern about what is going to happen of this manufacturing base when the world is moving towards a significant new kind of geopolitical setting, where a number of countries are using mercantilist instruments or trade protectionism in the form, of course, of tariffs, and this is what is happening from the US point of view, but also non-tariff barrier like the CBAM, which can be extremely detrimental to a number of countries who are trying to build up their industrial base. Next slide. We've done some estimation around the direct, indirect effect that this kind of new tariff and non-tariff barriers are going to have on the main economy, the economy for which we have detailed data. And when we do work in terms of looking at the direct impact on the specific product and sector, but also on the value chain underpinning this sector, so the indirect impact, we see that countries like South Africa are those that are going to be the most affected, exactly because they have a trade relationship with US, and this trade relationship are anchored around products that have been targeted by the tariff. Of course, the indirect effect, next slide, can be even more significant when we start looking at the value chain structure that underpins some of these sectors. So you see here at a more granular level, the extent to which these sectors, in particular in manufacturing, will be, so the tradable sector will be affected. Now, it's important to think about this industrial structure, because when we think about development finance, we do not we don't want simply to increase the amounts of finance that is circulating in the economy, but we want to direct finance towards productive investment that are part of, if you want, an industrial policy, industrial strategy for the government. Now, next slide. When we look at what has been happening specifically in the case of South Africa, there has been South Africa has a long history of industrial policy. It's not certainly a country where industrial policy has not been in the agenda in a way. We keep saying that, you know, industrial policy has been rediscovered, but effectively industrial policy has been in the agenda for a long time. But for most of this period, industrial policy has struggled to deliver on the ambition and the needs that countries like South Africa had, and that's the kind of picture that I showed in the beginning, all the parameters in terms of growth, investment, and so on, suffering over the years. In the current administration, there has been a significant emphasis in what in a number of DTSC, so the Department for Trade, Industry and Competition documents, are referred to as the 3D of industrial policy, an emphasis on diversification, in particular in downstream industries, where, of course, South Africa has struggled to open up, expand its economy, decarbonization, and so the need to think about how to restructure, in particular, those industries that contribute significantly to emission. If we think about globally, a few sectors like steel, chemical, cement contribute around 50–55% of the entire CO2 emission of the industrial activities. And of course, digitalization, the importance of using digital technologies to enable changes, not just in the productive sector, but also at the infrastructure level. It's impossible to have a decentralized or more effective energy technology mix. So having energy coming, electron brought into the grid from different sources without having a digital system that support, that balance out this complex system. And of course, all these objectives are in a way functional towards reducing poverty, in particular addressing the dramatic unemployment rates that the country is still suffering. Now, the issue of industrial policy, so it's not new in South Africa. It's been ongoing. A number of institutions like IDC, Pamela will talk more about that later, I assume, have played an important role in trying to translate the overarching industrial policy framework in South Africa in more concrete implementation plans, like the strategic plans that IDC has put in place, and also to, in particular, IDC trying to find ways to coordinate a number of efforts across areas that go from energy policy to financing to critical minerals and so on. Now, in this area, there has been significant effort, but still a number of problems have been highlighted. And from our own work, also as part of the Presidential Economic Advisory Council, President Ramaphosa, we still see a significant set of problems when it comes to prioritization and the need to understand a causational mechanism, how to sequence different interventions. If we think about at the moment, the energy system, the need to prioritize, of course, the investment in the grid is a precondition to be able to open the options for more investment in the energy and renewable energy sector, as much as creating standards that allow to give the energy to the grid a certification of a green or sustainable source. The second set of challenges that have been highlighted, which go back to the opening up in particular of the energy market for bringing in more investment and localization of investment in technologies like wind and solar, it's really related to the way in which these strategies have been designed and understood. In many areas, we have seen how the coordination between different policy functions, for example, the procurement with finance and investment in the grid, or the need to adopt instruments that are fit for purpose, are still areas where the government is significantly struggling. South Africa has been trying across many sectors to use localization strategies, for example. These local content requirements often are taking a standard form of local content, meaning we insert a number of parameters of local content. These are often very fragmented and make quite difficult for companies to localize investment. While at the same time, there are solutions that have been adopted in other countries and also in other sectors in South Africa as well, where localization can be achieved by changing slightly the form of the institutional form of the requirement for localization and trying to introduce mechanisms through which we leverage large companies to open up routes to market in the international market for South African domestic players. So in other terms, there is an ongoing discussion around what are the best institutional forms that the instruments of industrial policy need to take in order to perform the key functions that we have, given the evolving scenario globally and given the challenges that we have domestically in terms of the productive base. And finally, all these kind of interventions are, of course, dependent on the credibility that the government and the strategies that are going to be put in place are going to be implemented and sustained and enforced over time. We have seen across many countries, if we think about the set of comparators I gave in the very beginning, countries like Indonesia, for example, Brazil, even countries who've been successful in identifying the right functional form of the industrial policy, often they've struggled to sustain these interventions, and as a result, creating a significant amount of uncertainty that reduced the opportunities for investment. Now, if we think about, next slide, to the specific development finance. Developmental finance has multiple functions within its own, if you want, cluster of activity. In general, most African countries are in need to achieve three key things. Increasing scale, so financing at scale, especially in areas where we are not talking about microfinancial interventions, we are talking about investment that are transformative, that require long-term maturities, and that have to be sustained at a low cost. The cost of financing, and Adria will talk more about that, I mean, it's still significantly high in many economies, and here development finance institution can play an important role in reducing these costs and packaging financial instruments in a way that allows to address mismatches between maturity in terms of savings, in terms of source of finance and investment. Now, the key issue here to understand is that, of course, these kind of goals, scale, long-term maturity, low cost, can be achieved with very different institutional financing mechanisms. And it's critical to focus on the functions that we have to perform more than trying to reproduce in each country prefixed form of development finance. If we think about the example that I put here just as an illustration of what we mean with being open to different type of institutional forms that support the developmental financing function, we have an example related to the way in which BNDES in Brazil has been using a specific mechanism that allow to reduce dramatically the cost of financing in the country. At the moment in Brazil, cost of financing is around 15%. The Brazilian Development Bank, BNDES, has a mechanism that manages with the National Treasury, which allows basically to reduce the cost by using the National Treasury as an intermediate between international finance, where money is borrowed in our currency in the US dollars, and the implementation of financing domestically, where the lending is happening in Brazilian real. And BNDES plays an important role in creating a blending mechanism that allow to reduce and make possible a number of investment that would be impossible at the rate of normal rate of exchange rate, interest rate that we have in the country. But this kind of concessional mechanisms are only the apex of a more complex set of financing instruments. I mean, lots of the countries who have been successful in using development finance institutions have complemented concessional finance and broader forms of de-risking with specialized finance, private equity, public venture capital, so other type of institutional financing mechanism that can be much more targeted for productive investment. And of course, all these need to be supported by capital structures, so sources of finance that are not simply relying on international finance, but also on different type of domestic financial resources. So the problem now is shifting towards a situations where many African countries think carefully about what kind of mechanisms for domestic resource mobilization are in place. The discussion around sovereign wealth fund or even regional sovereign wealth fund that could leverage critical minerals or other type of resources abundant in the continent is an ongoing discussion, as significant problems in terms of course, institutional design and governance, but also promise to have potentially shifting a bit discussion from leveraging international finance from ownership of the development finance and industrial policy agenda. Next slide. The key issue that we also want to emphasize is that there is need to think about with an open mind around what kind of functions needs to be prioritized and needs to be embedded within development finance institution, what kind of forms this can take, drawing on international cases, experiences, the appropriateness of these forms. But ultimately, the key issue will be finding ways in which we design these development finance institutions, we reframe them in a way that is reflect and is able to address the very different financing needs that exist in the economy. There has been a sort of supply side bias in many of the development finance institution discussion, where the emphasis is very much on how to work towards a capital structure that allows to give concessional funds, but less on what kind of mix of financing instruments are needed in order to support investment that might be extremely different. And the African continent is in need of such a variety of investment, going from venture capital, public venture capital, down to more traditional long-term maturity finance. I stop there. Adria will continue bringing in more concrete empirics around what we've been observing in the African continent.
Hi, everyone, and thanks, Antonio. I'm just taking over and going forward with this a bit more concretely as well on the paper that was circulated. And before that, just think it might be useful to take a step back and look at some of the data that are available, which basically show the recent trends in terms of development finance institutions and how have they evolved in the past 10, 15 years. And what we see is actually, as I think many of you know, is a revamping of DFIs, both in the number of DFIs, but also in their role, specifically since the COVID crisis, where actually many DFIs in Africa took more active approaches to dealing with the crisis by using their instruments. We see that this is relatively regionally concentrated, particularly in West Africa, but nonetheless we see an overall trend. There is also information about the different types of DFIs and what are the different mandates. We see in this plot where, again, as mentioned, there has been an increase at least since 2010 in the total number, and then the structure in the sense of the types of DFIs remains more or less similar in the sense that most of them have a flexible mandate, meaning that they are not specialized in, let's say, serving MSMEs or financing infrastructure. However, the role of MSMEs and serving MSMEs remains quite crucial. In the continent, there is a high heterogeneity as well. So we see significant differences in the scale of the largest DFIs in Africa in comparison to the smallest ones. If we look, of course, at the overall asset value, when we look at the relative weight within the country, that might change a bit. And in here we see both the DBSA and the IDs in South Africa as amongst the top in 2021, just below Morocco, CDG, and the Agricultural Credit Institution. So going back to what Antonio mentioned in relation to the specific mix of instruments that is both enabled by the capital structure and the way DFIs are funded, we've started doing work specifically in this project trying to ask about possibilities for domestic resource mobilization that can mobilize financing that can be used as a source of capital for DFIs and therefore can be mobilized from sort of perhaps more dormant stages to a more catalytic industrial policy, structural transformation driven type of financing. And using data from the Africa Long-Term Finance Initiative, we sort of highlight and build on existing discussions on the opportunity of perhaps, and the main contribution here is basically empirical, trying to understand a bit the situation, but of course, the logic is that there are many what we might call public institutional investors, such as pension funds, sovereign wealth funds, and so on, as Antonio mentioned, which both hold significant pools of finance and which paradoxically, in some regions, in some countries, they engage in not maturity transformation, there's maturity transformation. So they actually pools of long-term finance that is not invested in long-term assets, or they don't make long-term investments. And in many cases, it is very safe, very secure, of course, for very good reasons for the purpose that they play. But we are asking whether part of this reverse maturity transformation is actually an opportunity to, if we connect those long-term liabilities or sources of funding with the own capital structure of DFIs, which we know that domestically are constrained, and that is a significant issue. So we've started mapping and asking if DFIs are actually more or less reliant on this source of domestic resource mobilization, both with a preliminary set of 14 development finance institutions in Africa for which data were available in 2023. And we've been looking both at the breadth, so basically if PII engagement is present in many of these DFIs, and actually we find that in some cases it is, and also the depth, so how important it is in comparison to all of the sources of, again, it's external and non-equity finance, and we provide BNDES as a comparator. And we basically try to understand how the specific form of financing, for example, subordinated debt in the case of BNDES, might be important for enabling long-term lending conditions for DFIs and therefore mobilizing that finance for structural transformation purposes. In addition to this, we've got the demand side that Antonio mentioned as well, where we are trying to both match these two dynamics, these two elements of first capital structure with rethinking what are the heterogeneous financing needs in relation to industrial policy. And for that, we're starting doing work in trying to basically break down where does this heterogeneity come from, and therefore how specific, again, capital structures can be used to craft mechanisms and financing instruments that can be specific to the heterogeneities of needs that are present in many countries in the continent. And for that, we've started, again, mapping the role of DFIs within the broader domestic resource mobilization within public sector entities in different countries, which you'll find in the paper, and therefore trying to understand the relationship between the sort of sources of capital in comparison to the instruments that they can deploy. This is ongoing work. Some of that is already out as a working paper, and is also in collaboration with IDC, whom the CSST has sent an MOU as well as Benedes. So thank you very much. We more or less made it on time, and looking forward to the discussion. Thanks.
Thank you very much. That was certainly very insightful and lots of food for thought. And yes, thank you for keeping to time. So, Prof. Antonio, you mentioned the key issue is to find ways to reframe and redesign financial institutions that address the finance needs in the economy. What would you say are the most critical institutional linkages that are missing in South Africa's development finance system today?
Thanks, Margot. I think I'll be brief because I'm also very keen to hear our panelists to engage with this issue. And one of them, Pamela Mondliwa, a co-author friend and someone we've been working with over the years, there is an important conversation there, which links to what we were discussing towards the end of the presentation, which is how to think about a more coordinated effort across the, if you want, the three main players, the South African Development Bank type of specialization and mandate, IDC, and the broader PSC and the pension funds that exist across South Africa. Now, the coordination is important because in a way, these are institutions which have different mandates, different priorities in a way, but there are areas where they are highly complementary. So already there is, as the chart that Adria showed at the end, there is, if you want, interdependencies between them, in particular, of course, PIC and IDC. But these interdependencies should be more thought through from an industrial policy angle. So how can you strengthen this relationship between these public sector institutions or institution with a public mandate to actually try to, if you want, create a pool of resources that are sufficiently large and sufficiently de-risked that allow to address the kind of investment needs that are required nowadays. And I think, just to conclude, each one of them have a quite unique, if you want, condition, which in industrial policy is very important. They are, of course, embedded in government in the sense that they have a public mandate, but at the same time have degrees of autonomy, or at least mechanisms that allow them to operate in a way that respond to broader stakeholders. IDC, Pamela will say more, but these are players that raise funding in the international market, and they need to show their books being sustainable, being financially sound. Similarly, the comparator of Benedes is very interesting from that point of view. The chart that Adria showed is that their capital structure is very much built on public investment, or better, public finance, and that there is a specific provision in the law. But even for them, it's become very important to be able to raise with bonds more finance to address the needs that exist in the Brazilian economy. So as soon as you start diversifying the sources of finance, you start having a broader set of stakeholders into the conversation, and that might reinforce paradoxically the autonomy of this institution in delivering and implementing industrial policy.
Okay, thank you. Okay, and let me invite all the panelists to switch on your cameras as we continue with the panel discussion. And I think my first question will go to Adria Rius, just based on that you've also presented. Thank you. And for there, I would like to ask you a sort of a more technical question based on your analysis of the several African DFIs. Which models of collaboration between, say, pension funds and development banks stand out as the most promising and replicable for South Africa?
Thanks, Monica. Yeah, it's a great question. I think that there's quite a lot to learn from each other. There are different models, and as I mentioned, one of the main output of the work we've been doing is to highlight that it's important to understand this relationship in relation to the broader efforts to mobilize resources. So the case of Rwanda, for example, has a different model where actually the ownership is partially coming from the Social Security Fund and Sovereign Wealth Fund. So that is, for example, very different from the case of IDC. Again, IDC is self-funded. That is not the case in other DFIs. We've got examples where it's not just pension funds, but also central bank providing guarantees and providing different types of instruments that support the capital structure of DFIs and that enables them to also leverage more funding, get better gradings, and credit ratings, and leverage more funding, more private funding, and even which then reinforces the asset structure, which helps build up the capital structure again. So I think it's difficult to, of course, replicate. This is very context specific, but there are different models, and the heterogeneity is quite high across the 14 DFIs that we've considered in the continent.
Okay, thank you. Yes, so the risk and perceived risk is certainly a very big topic. And leading on from that, and also with what Antonio Andreoni said, I'm going to go over to you, Pamela. If we look at the IDC, it plays a unique dual role. It is both a policy instrument and a commercial investor of sorts. How does it balance risk or perceived risk appetite with the development impact?
Good morning, everyone, and thank you very much to to Antonio and Adria for the great presentation and the work that they've been doing in this area. So I'd like to reflect a bit first from the perspective of how the IDC goes about with its resource mobilization, and then link that up to our own risk appetite in terms of how we lend. So as outlined in the paper and the presenters have put forward, the IDC is self-financed. So the last time we received funding from the state was in the 1950s. And yes, we do manage some funds for on behalf of the state. So if you look at the budget book, you might see some lines that say IDC, but this is not straight funding. It's managing a particular fund with an objective that is set out by the state in that regard. So because we then have a combination of money from the equities that we hold, as well as businesses that we've invested, and of course the repayment of loans, but we also borrow and do this quite regularly. So this means that we are then subject to all the systems that are in place from a borrowing perspective. So when the credit raters rate us, right, they look at things such as sector concentration risk. Now, from a DFI perspective, this has tended to be very problematic because the rating agencies see sector risk as a big red flag. But our mandate is industrialization. So us having high exposure in manufacturing is a default because of our mandate. DBSA having high exposure in infrastructure is by default because that is their mandate. And navigating that conversation with rating agencies and the financial system altogether is a very difficult one because now we are seen as risky simply because of our mandate. So these are broader things that we really do need to think about. And as development finance institutions, in developing countries is an ongoing conversation that we are having. And the big challenge is always around the mismatch between the long-term finance that's required by the clients and the relatively short-term finance that we are able to mobilize from the market. So think for an example of a avocado farmer, because we do also finance high-value agriculture. It takes 5 years for an avocado tree to grow. So this means that you cannot reasonably expect that within those first 5 years, that client is going to pay you back. But the money that you are borrowing to lend to that client needs to be paid back within those 5 years. So these mismatches then create a thin line that we're continuously having to navigate. Then in terms of the IDC's risk appetite, so this differs in a number of industries depending on how we have prioritized them. So for instance, we're playing a big role around supporting sustainable industrialization, and particularly around the low carbon and green growth. And a lot of these investments are quite risky. So, but we are taking on that risk, and what we've done is really applied an ecosystem approach to thinking about these investments. So we're not thinking only about the actual investment, but thinking what are the things that need to be in place generally to be able to support this. This is the coordination issue that the presenters spoke to before. So when we think about green hydrogen, we're not only thinking about the production of green hydrogen, we're thinking about the infrastructure that's required to provide that. We're thinking about what are the regulations that are required to support investment decision-making in that process and advocating at a policy level for these decisions to be making. We're thinking about what is the type of funding that is required in mobilizing this. We've been able to mobilize, including grants, for some of the green hydrogen projects, which are very much required. So as far as possible, we are seeking to play a coordinator role, but there are limits to what we can do in this regard, of course, because a lot of the decisions that need to be taken sit outside of our control. So it's more about convening people, sharing information, encouraging these decisions to be made to support these developments. But certainly our funding structure does to some degree limit our risk appetite. Our risk department, does hold the line on us and to ensure that we do not breach the limitations that have been set out, which are required because of just the system and the way that we are funded and how we play in that system.
Okay, thank you very much. And yeah, that is very powerful. And what would you say resonated most with you from the presentation that we just received?
So a lot of it resonated, and we have been having continuous conversations and discussions with the Center for Sustainable Structural Transformation on these particular issues. Perhaps the one thing that I would like to re-emphasize is the point that was made by Professor Andreoni right at the beginning, that finance is not a silver bullet for the industrialization requirement. It is a very important instrument, but it is not a silver bullet. So the issues around thinking about how to build the ecosystem. So if we think about it, what have been the typical industrialization development challenges? You thinking about, what Alice Amsden used to refer as getting relative prices wrong, right? So interest rates are a big part of this. So if we are giving loans as the DFIs, we've got a role to play in this regard. But there's also a link broadly to the macro and monetary policy, environment that plays out, and these things need to filter back and really be, from a South Africa perspective, be designed and coordinate so that we are able to achieve our ambitions as a country. So it was also mentioned that South Africa has had industrial policy for a very long time, which is true, but the results have been quite mixed. And a lot of the time, the reason for the failures has been poor coordination of the instruments that are deployed to be able to support these things to happen. So for example, from about 2007, South Africa had the National Industrial Policy Framework, which set out and identified key role players in establishing or supporting the competitiveness of industries. A few years ago, when I was at the Center for Competition Regulation and Economic Development, we actually went to all the IPAPs, which were the implementing documents, and then checked against the performance agreements of the departments. Things that were in the IPAPs were not reflected at all in the performance contracts of the departments. So this was telling you around the gaps that existed. So the seventh administration is emphasizing the importance of coordination. And so we are hoping to see, and at least as the IDC, working towards supporting that coordination very much. Then with regards to the relationship between the public financing institutions as well as DFIs. I mean, we're working closely with PIC and UIF, and we are hoping to deepen these relationships for the IDC to be able to solve that tension between the requirement for long-term finance and then the financing that we are able to get. That's really a point of emphasis with regards to the partnerships that we are creating with financiers. Thanks.
Thank you so much. So bearing in mind that we have encountered coordination issues, I'm going to look at drawing in an international perspective. And here I'm going to pull in Diana and Prof. Michael Jacobs. So first off, my question to you, Diana, is if we look at the global experience, what does good look like? And you've worked with DFIs across several continents. And what distinguishes high-performing DFIs, and what can we learn and use from a South African perspective?
Margot, thank you so much, and good morning, everyone. And thanks so much to Professors Antonio and Adria for your presentation. Let me just introduce myself from the perspective of a practitioner. I've worked within a number of national DFIs globally. Someone's celebrating that. I just saw the little... And I've seen how these work from a very practical point of view across up to 80 countries. I've kind of lost track, and really looking at the models in developed countries. So we've worked, I'm Canadian, so we've worked across the Canadian DFI system. There's 5 institutions in Canada, Japan, Finland, Germany, and then across the full spectrum. And Africa is actually where we do most of our consulting work. So I'm quite familiar with the global system. What makes a good DFI really starts at I think the biggest area is governance, is the system to be able to link with link with the government policy. And in that instance, what does link mean? It could be aligned to. So just reading the National Development Plan and aligning to it. It can be engaged with, so having regular conversations. It could be embedded in the policy dialogue. But what you want to be clear about is not to be directed by. And so we've, in many instances, run interference between let's say the board of a DFI and the Ministry of Finance, or whatever ministry has the oversight responsibility, to say the managing director, CEO can say, yes, minister, comma, not yes, minister, period, because those interventions are very important to make sure governance is clear. So governance is a key thing. Obviously, the quality of the credit appraisal, whether it's a DFI doing MSME business or infrastructure, you need solid banking skills to be able to do credit assessment. But then I think it's also critical for a DFI to understand their position within the market. We talk about the need for mobilizing private capital, but I've seen DFIs in different countries that have actually maybe even inadvertently crowded out private capital. They put a term sheet on the table of a customer that also has a term sheet from a commercial bank. How is that effective? So there is a mindset within a DFI that's really about being catalytic. So maybe I'll describe it that way. Obviously, the operational and organizational structure of the DFI needs to be clearly managed. But I think if you've got a solid governance structure where everybody understands their role, you've got a strong credit. And when I say credit, I'm of course meaning the appraisal process includes ESG, includes climate risks, it includes all the thematic areas, gender, and I know my co-panelist Annie will cover that, but is really taking those aspects into account, but then is a well-run financial institution. So let me leave it at that, because I think that hopefully answers your question.
Yeah, it definitely does. It definitely does. And yeah, with the governance, I think it's important to have the priorities clear so that everybody knows which one thing to focus on at one time. And from that point, which would you say resonated most with the presentation we received?
Well, I think, you know, it's clearly, and Pamela did a wonderful job explaining when there's a mismatch in maturities between a DFI borrowing and a DFI lending needs. I mean, that's clearly an issue. And of course, the mismatch in currency. And so it may make sense for an IDC to be borrowing internationally because ultimately the exporters, the South African companies who are borrowing from IDC will be exporters earning foreign currency. It's more of a challenge for a DBSA that's an infrastructure bank building infrastructure that may not be generating foreign exchange. So that's a clear point. Where it then needs to come to is how do we mobilize local long-term capital? And obviously, yeah, pensions and other long-term assets. What is the mechanism? But it's beyond a mechanism. What is the conversation with them? And we've seen in many of the mandates that we've had where we've gone into development banks and we've sat with their treasury operation and said, well, what conversations have you had with your pension fund or your social security fund? And we hear on that side the desire for it, but then we go across the street and speak to the social security or pension funds, and they said, no, we don't have a mandate to invest locally. We're very low risk. There's no development mandate here. That's a different mandate than is expected from us. But they'll do cross-border investments. They will do, nothing directed towards what's beneficial to the country. So they're singing from the different songbook, really, between the pension funds, and of course they're regulated. So the regulators of the pension funds are not thinking about in any way what's sort of good for the country. So I think there's often that disconnect, and I don't know enough about the South African situation. PIC is obviously a very important investor and has actually, from what I know of them, a broad perspective, and they understand and are given more freedom than I see other, institutional investors across other countries.
Okay, thank you. Thank you very much. So over to you, Prof. Michael. Thank you for joining us. So Diana has mentioned that there is a disconnect between the local and the international institutions in some level. And globally, we're seeing the G20 and MDBs rethink the financial architecture for climate and development. What implications does this have for middle-income countries like South Africa? You're on mute.
Thank you very much, Margot. Good morning, everybody. And thank you to Antonio and Adria for your presentation and for the background paper, which I read with interest. The conversation we're having today about South Africa is being replicated all over the world. So this is not a unique situation by any means, and not just in emerging and developing economies. I come from the UK, where earlier this year, the Chancellor of the Exchequer, our finance minister, announced that she had effectively strong-armed British pension funds into investing in the UK because they don't do it. British pension funds have historically, as Diana was just saying, had relatively low risk appetite absolutely no interest in development financing, invest in a lot of securities, sovereign bonds from around some of which are British, but most of which are not. And the idea that they should be a source of financing for development and investment in the UK kind of has never occurred to them. And our finance minister kind of, in a very public show of force, kind of gathered them round the table with cameras, you know, and berated them for their investment strategies. And they have now all agreed voluntarily, kind of semi-voluntary, I mean, it is voluntary, to invest more in the UK. And most observers are kind of going to, are watching this and saying, well, we'll believe that, you know, when we see it. So this is not the low rate of investment of pension funds and institutional investors, public institutional investors, into DFIs or indeed at all into domestic economies is quite common, and there are good reasons for this, which is risk appetite relative to your responsibilities. So pension funds in particular, which have direct benefit schemes, where they have predetermined liabilities. So their liabilities are not determined by their investment performance, but by the contracts that effectively pensioners have got with them, are incredibly nervous about losing money. And so they have relatively low risk appetite. And the best of them do try to match the length of their terms of their investments with their assets, with their liabilities. So their assets and liabilities are matched in length of term, so that the money comes, they get the money when they need to pay it out. And that a lot of their portfolio management is based around that. And the idea that one of the criteria should be investing in their own country is kind of neither here nor there. And part of this is culture. Part of this is kind of culture of those investment funds, and part of it is regulation. So pension funds and other institutional investors, insurers and others are heavily regulated, and they are regulated to abide by their fiduciary duty, which is to provide their pensioners with their pensions. And the regulatory regimes, which are international and then domestically kind of interpreted, are again entirely focused on their responsibilities to their investors and not at all on their responsibilities to their countries. So the really interesting paper which Antonio and Adria have written, which analyzes how much of DFI financing comes from public institutional investors, and the answer is, in many cases, not very much, is you have to look at this from the other side, which is what are the investing strategies of those PIIs, and what are the regulatory regimes they operate under, and what are the cultures they operate under. And so the world over, there is now a search for structured products which are the kinds of things they like to invest in, PIIs like to invest in, which could have as their core, the core asset, development assets with development characteristics, which is often infrastructure, but which could be manufacturing or other elements of green industrialization. And because a lot of the world's kind of development planning is now green in one form or another, and often gender responsive and various other things, it's that the underlying assets need to have those characteristics, but they then need to be bundled together and structured in a way that looks attractive to an investment manager in an institutional investor who is not primarily interested in any of those things, is only interested in the return and the weighted risk and the tenor of the loan. And so this is now a huge international agenda, which is how do you structure the products so that they look attractive to investors in those PIIs who are not really interested in what you're trying to do at all.
Thank you. And when you mentioned a lot of it depends on the culture and the regulation, For South Africa to lead in this space, how does the communication or the partnership look between domestic and international parties in such a way that if we were to connect, we could lead?
So this is the difficult question, which is that the regulators are independent, rightly, and they have mandates which are all about fiduciary duty, financial stability, and so on. And of course, particularly the financial stability side of the regulation has become more difficult in recent years. The financial crash of 2008 was a massive wake-up call to the regulators to say you've not been regulating banks in particular, but more widely very well, and so they tightened all the regulations, and those regulators do not have development priorities. They are not there to help countries develop and to help development in banks do exercise their mandates. So and governments are not, in order to change regulation, governments need to legislate. This is not just a policy question. It's not kind of what are your priorities, it's what's the legislation. And legislating to weaken your financial regulations will not go down well on international markets. And governments who do that have their own sovereign credit ratings to consider. And so this is a very difficult area for government policy, and certainly for DFI policy. And the DFIs are not really and even governments are not really in charge of this area of how you get more money in. What I think is now interesting is that many DFIs, but mainly the big multilateral development banks, and then one or two DFIs, of which BNDES, which Antonio and Adria have used as their comparator, the Brazilian Development Bank, which is enormous, and has a very long-standing history of being part of the development of the Brazilian state. So it's a kind of really central institution in Brazilian economic life, in a way that some DFIs are really not. Brazil and various MDBs, including the IFC, the International Financial Corporation, the IDFC, which is the private sector arm of the World Bank Group, IDB, the Inter-American Development Bank, are now experimenting with the structured products by which they can attract new forms of capital. So Brazil has something called Eco-Invest, which is specifically aimed at environmentally focused investment, which offers various kinds of credit lines and structuring to help bring in private capital. IDB, Inter-American Development Bank, has now got a really interesting program in which they are buying they're going to be buying performing loans, and then from ordinary commercial banks, performing loans, so loans which have good returns, and we know that because they've been performing. They want to buy up some of those on condition that the commercial bank, who is now given some money in return for that asset, invests it in nationally determined investments in the countries. So and then they will sell on that new performing loan. They will bundle the performing loans so that they risk pooling. They will add some foreign exchange guarantees, some credit enhancement, which they can do because they're a AAA rated development bank, and then sell products which are investment grade structured products to pension funds, which are just the kind of things that pension funds like. But the underlying asset then is a performing loan. We know it's performing, and the new money that is then released is going to development finance in countries. So that's a really interesting idea. That's IDB Reinvest Plus. The IDFC is now looking at, and others are now looking at originate to distribute models. So instead of a DFI investing in whatever asset it is, infrastructure or an SME or whatever, and then holding on to that asset for the rest of its life, you sell it on, and when you're selling it on, you're selling it as a structured product which has a track record, which is what a public institutional investor wants, and so on. So this is now an international agenda, and everybody's experimenting. This is very early in much of this. The original blended finance model of kind of de-risking has yielded not much. The money flows have not been huge. They've been very difficult transactions, and very expensive. And we've had concessional finance being used basically to subsidize the profits of investors around the world, which is not clever, particularly when concessional finance is in decline globally. So this is South Africa's agenda, but it's also the rest of the world's agenda too.
Yes, thank you. That is fascinating, and we can certainly learn from Brazil. I like the idea of the long-term approach with a track record, and I'd be very curious as to what metrics they're actually measuring in terms of impact outcomes. And with that, I would like to take the discussion to Annie. And when we look at how we have had so many, we have the number of development finance institutions has grown so much over the past few years, and according to what Adria was presenting, a significant portion of those were in the flexible category. So we're looking at how they specialized and they targeted, but there's this flexible category. Based on the gender mainstreaming and the ESGs, what could you say from that perspective in those, sorry, let me just,
okay.
Yeah. I think you get my point.
Sure.
Yeah.
Yes, indeed. And I must say this is a really interesting discussion. I am not usually involved in such high-level finance things, so it's really interesting for me to be part of this discussion and listen to the fantastic inputs from all of you. It's difficult in this webinar to really analyze where we could take this in terms of women-owned businesses, because we know so little. I mean, very few people are doing any real analysis, or certainly not sharing it. They may be doing it. And I'm extremely interested to hear what Michael's saying, because that sounds to me like we might have some edge into how we can get women-owned businesses into these industrial processes. I mean, the problem, of course, is that theoretically, there should be no difficulty. But women aren't involved in industrial processes. It's not something that they've been involved in at all in many places, except in Europe and perhaps in Brazil, but certainly not in South Africa. We're not seeing, I have asked around, and I've tried to speak to people from the IDC about the level of funding that goes to women-owned businesses in the industrial processes, and it doesn't seem to be very high. I know that the IDC has some funds that have been used for women-owned businesses on the more sustainable side, and looking at where businesses are formed in collaboration with employees and various things like that. And certainly all of the funds say preference will be given to women-owned businesses and small enterprises. But mostly, I think this is very difficult for all the reasons that Michael said, that you know, the risk is the critical issue, and you can't go taking people's pensions funds and giving it to people who might not be able to make a profit out of the money. So it's a bit of a quandary here. And so I think I would be very interested to see the examples that Michael was giving, and seeing how we could use them in some of our DFIs here. We certainly have seen some crossover. So there is, and I've mentioned this before in other webinars on this series. For instance, we have a fund called, an organization called Indalo Yetu that has done some very interesting work with smaller banks, with national banks, like in fact, in this case, it was with Netbank, who have managed to put together funds that are suitable for women-owned businesses and had great success. But again, we see women in some areas and not in others. So you're very unlikely to find them in the very industrial minerals and energy complexes, but you'll find them in the sustainability areas. You'll find them producing sustainable goods for industrialization. You'll find them in waste and recycling. You'll find them in health and PPE. So I think that's also an issue, is what value chains are we funding, and how can we focus some of the finance towards those areas where we can start getting more inclusive development. But we're very far away from that at the moment, and we do need to advocate for changes on how policies are oriented towards making this more accessible through the ideas that the IDB has done, which de-risk these finance mechanisms. I hope that's helpful.
Certainly is. Thank you. And at this stage, I would like to get anyone's response based on that. Let me start with you, Prof. Andreoni, based on the points that have landed, and especially what Annie has said, looking at the linkages that might be missing in terms of that mainstreaming. What comes to mind?
Yeah, I mean, let me just reflect on a few issues, because I think the panel has been very rich in bringing lots of the criticalities here. Maybe let me just make sure that we reflect on at least another couple that I think are very important, and I'll come also to the point you just raised. We've discussed about, risk and, structured products and all of that. I think we need to be aware of the fact that ultimately, if we do not rebuild capacity in understanding investment and understanding productive investment in particular, how different they are, everything will look very risky. So risk is it's also a function and reflection of the extent to which development finance institutions, or those who are able to pull together financial resources, are able to see and understand the way in which investments operates, the extent to which investment can become much less risky if governments, for example, are able to stabilize prices, stabilize issues related to demand. Across Africa, we have major problems exactly because traditional development problems. Lots of things could be bankable, could be a viable investment, but there are so many other conditions that have to be met in order for this to happen. We have been looking, for example, at the need to leverage a significant amount of resources to support investment in green ammonia production, and that is not simply for industrial processes, it's for ultimately production of fertilizer and other type of inputs that go down to the value chain of small, medium enterprises and farms and so on, which require those critical inputs to be more sustainable in production of food, making more inclusive outcome in terms of food security, and so on and so forth. So this kind of need, I think there is a general cultural problem. Development finance institutions lost the capacity to operate as investment arms of the government, and in general as a coordinator player. And I think Pamela's was really nailed the issue, how we can rebuild this capacity, how we can learn from what IDC is trying to do, what Benedest has been doing for many years, what other players, also sovereign wealth fund, have done in other parts of the world. If you think about Khazanah in Malaysia and others. The second point that I think we haven't covered yet is that there is a significant, and this speaks to the issues around regulation that Michael raised. We need to be able to channel resources towards enterprises that are able to generate sustainable outcomes, that are able to generate more sustainable products, services, and so on. But we need to also have regulation that makes sure that the resources that are flowing into these enterprises, especially the large one that affect the overall ecosystem in terms of its functioning, these resources are also retained and reinvest in these companies. We have a pattern of hyper-financialization, which has been, in particular in South Africa, because there is an institutional vehicle with the stock market that allows to have a huge outflows of dividends and stock buybacks that have undermined the capacity of large players to actually invest. And some of them are also players where the government has shares. So we need to have an approach that look back at corporate governance regulation, look back at how the state uses strategic control of share of large players like Sasol, for example, or players in Anglo-America and others, that require these companies to do not simply have better financing, but also to direct this finance towards a cycle of retain and reinvest, without which this cannot operate. And the last point, I think, that was raised around how to make sure that there are both structured products and blended finance and mechanisms that allow to also reach or overcome the kind of trade-off that Hannah was referring to, right? Some certain type of investment activities that might be perceived too risky or not sufficiently. I think that is an area where we need to think carefully about the way in which we support this kind of initiative, because I think we do not always have to apply the same the same instrument, right? There could be mechanism in which the governments deploy other type of schemes, which are not necessarily financing schemes, to provide access to resources that are potentially required to meet this kind of more inclusive outcome. I think we do not need necessarily to apply the same type of recipe across all these different sectors. And I think we need to be able to look at the inclusiveness agenda in a broader sense, right? Pamela was referring to the work that also she was involved in the Center for Competition, Regulation and Economic Development. There are lots of outcomes that we can achieve in terms of improving performances of small, medium enterprises, not with using finance per se, but for example, making sure that markets are more competitive, that players are not abusing their power position, as small, medium enterprises can have a fairer share in operating in the market and having a profitable return. So the assumption that certain activities are not profitable might simply depend on the fact that we haven't used regulation or competition policy in an effective way. So their margins are completely squeezed because, let's say, I'm producing food and the supermarket chain is controlling prices, and I look not profitable, but effectively I'm profitable. Simply, I'm not able to capture the value that I'm generating in that value chain. So in that case, I could be bankable. I simply need to have a regulator that reduce that abuse of power or concentration and introduce more rivalry in the market for that company to become efficient, effective.
Thank you so much. And just bearing in mind the timing, I would like to move over to some of the questions in our Q&A also. So I'd like to acknowledge Admasu Dumagu, who says, we need to focus on the challenges of the globe, rapid urbanization, impacts of industrialization like climate change. Here we go, partnership is needed. So based on what Annie was saying and topics that have come up, Michael, how could you respond to that?
Well, I think this is the kind of real question, which is what is it that we are trying to finance? What is the development path? And how do people conceive industrial policy? So part of the problem is in the term. Industrial policy is the name that we give to an attempt by governments to influence the course of economic development in a kind of proactive way. But we use the term industrial policy because the original versions of this were all about industrialization in a rather traditional manner, basically manufacturing industry. But of course, economic development is not all about manufacturing. Manufacturing is important. Manufacturing offers opportunities for exports, which is important. But the kind of traditions of industry that most of us have in our minds are not how economic development occurs everywhere in the world, and that's often highly gendered because many of the industries that people have in their minds, often subconsciously, are dominated by male employment, and there is a kind of mental obstacle to thinking about industrial policy in terms of services, artisan sectors, retail, distribution, water, and basically all the things that aren't manufacturing industry, which is what people, even without quite realizing it, have in their minds. We have a very interesting case study of this in the UK, where we have a female Chancellor of the Exchequer, Finance Minister, who wrote a pamphlet when she was in opposition called The Everyday Economy, in which she pointed out that there are many, many kinds of sectors in the economy which are productive, and indeed where productivity is too low. And that's actually the ones that really, if you've got an industrial policy, you want to focus on the low productivity sectors, many of which are dominated or have very strong female employment ratios. And she said industrial policy must be focused on the everyday economy and not just on aerospace life sciences and high-end manufacturing. And she has come in as finance minister, and the government's industrial policy focuses, surprise, surprise, on aerospace, life sciences, and industrial manufacturing, and not on the everyday economy. And that is because that's where the lobbying is. Those sectors have very, very strong lobbies. They are very well organized. They're big companies, they're global companies, and they employ a lot of people in concentrated sectors. So you can see all the people in one go, as it were. Whereas the everyday economy, the economy in which many women are employed, consist of smaller firms. They're less visible, and you need a different kind of funding mechanisms, because you need much smaller loans, grants, and various other things, as Annie was explaining. So this is kind of structural problem with the idea of industrial policy. And then coming to the question, this is a global issue, and we are facing a global climate crisis and indeed wider environmental crisis, which it is every country's responsibility in its own context to respond to. And most countries have commitments of that kind, but they are very challenging. And, you know, speaking from outside South Africa, I hardly need to explain to a South African audience just how challenging, you know, your energy transition is. The government is committed to an energy transition of shifting away from coal, but a lot of people work in the coal mining industries, and they are concentrated geographically, and, you know, this is all that you know. So this is a huge challenge, but it's also a very difficult one. And so we shouldn't underestimate the extent to which, although we may be critical of our institutions and our governments for not doing things, they are facing really, really difficult challenges. And the climate crisis has made it more difficult. Strategies which were once kind of thought to be, well, we should definitely be going for mining and coal and so on, are no longer so obviously straightforward. So this is a global challenge, but it's a very difficult one, and the international climate has got a little bit more difficult over the last few months, as everybody is aware.
Yes, it certainly has. Gosh, and yeah, lots of points we could go on from there. But what I'm going to do is I'm also going to look at Itumeling's question. Itumeling says, it seems the mismatch between borrowing and lending is key issue in providing patient capital in DFIs. Given the high levels of financialization in both global and domestic capital markets, what alternative mechanisms could be explored to address this issue? Are there any state and regulatory levers that could be pulled? In the first webinar, we looked at the idea of moving DFI's balance sheets to the South African Reserve Bank to unlock more capital. That question was raised. So I'm going to pose this question to you, Pamela. What are your thoughts on that?
Oh, a very good question by Itumeling there. So the paper puts forward around, deepening that relationship between public institutional investors, and that's a potential solution. And I would take that further to say even private institutional investors, because if you think about it, they have long-term liabilities. So if you're thinking about pension funds, you might have a lot of members. Some of them will retire in the next 5 years, but most of them are going to retire in the long term. So you can invest in longer term. You can, finance DFIs with longer term maturities that then support the long-term investments that are required. So we really need to think about how do we start unlocking that conversation and moving to a place where this is now becoming common. So, I mean, I think at initial conceptualization of institutional investors, the thought was always going to be that they would fund in the long term. So with financialization, as Antonio has mentioned, we've now seen a shift that even they are thinking about the short term. So that slide that they put up there, where at a time when gross fixed capital formation was falling in South Africa, the market capitalization of the Johannesburg Stock Exchange was at some point about 300% of GDP. That tells you just about the weakness in the relationship between what's happening there and what's happening in investment. And some of the largest investors in the JSE are your institutional investors. So how do we start rethinking and unpacking that conversation, and what do they require? So let's have these open conversations for us to be coming into that form. And a point that was made that I'd like to emphasize. So there are nuances and complexities with regards to industries, that need to be unpacked and perhaps some of the investors don't truly understand. Let me make an example, for instance. It's now common cause that critical minerals are a big industrialization opportunity for Southern Africa. However, there are a lot of project and financing tensions that lie in those types of investments. And some people or investors may consider it, you can come in with debt in that situation. But actually, because of the number of risk in terms of, so there's lock-in, if you think about critical minerals that will form part of batteries, there's technology lock-in risks. So you need to think about how you're going to balance that. There's also a timing mismatches that can arise because you first have to invest in the mine, get the critical mineral out the ground. Then by the time you can invest in the processing that can happen, time has lapsed, things have happened. And so in funding those types of investments with debt rather than equity also compromises their success over time. So how do we really understand what is required in these industries, which are big opportunities? And we know demand is growing exponentially for both critical minerals and the products thereof. So it's in the long run, this is going to work, but how do we finance it appropriately so that we are able to optimize in that regard? I think, and DFIs need to do more to share the information and the understanding that we have. So for instance, the IDC in 2020 introduced an industry planning unit, which was created specifically to really do these deep dives around these particular questions. So I think it is our responsibility to share more and more the work that we're doing in this regard. So other things that can be considered, there've been quite a number of recommendations around, the fiscus can come in one way or another, right, in terms of funding these. So a recent exercise that I did was to look at the IDC Act since 1940, when the organization was established until now, and it's been changed 13 times. In that early part, there were continuous changes that were particularly to enable it to do and support industrialization. And one interesting one, which was in the 50s or perhaps it was in the early 60s, was that in the IDC Act, it was very clear that the government had to guarantee the IDC's borrowing, and specifically for the petrochemicals industry. And at that time, the IDC was trying to support the development of Sasol, right? And so part of the success of a company that came from nothing, that was really supported by not just the development financing, but the broader ecosystem, the regulatory issues that Antonio is speaking about, and various other things. But there was just that targeted attention to how do we make this work? Thanks.
Thank you. I liked what you said about looking at the optimal way to finance the, this increasing demand and taking into consideration the long-term aspect. And with that, I would like to direct some of the questions from the Q&A to Adria. So people have been speaking about the correlation between the number of DFIs, which has been growing, and the level of industrialization and economy. They've also been asking about the ownership structure of the DFIs and how does that impact the role and the capital structure. And they've also been asking questions from your presentation about the number of DFIs in Africa growing and the asset base looking small. What implication does this have for resource mobilization? So what are your thoughts on those?
Thanks, and thanks everyone for the reflections and for the questions. It's a very exciting discussion. Just before this, I wanted to react to one of the comments, just to drop a sort of a data point, which is that when we look at firms and how they finance investment, and this is in relation to financialization, as important as external financing is and the sources of that, this is the case of DFIs. Financialization is about the internal sources of financing, and we should remember that across the globe, still most of the investment in firms comes from internal resources. I think it's on average around 70%, right? And that's where financialization is really problematic, because you are defunding firms from being able to do that, and bringing in external finance is a limited way of addressing that investment needs. Going into the questions, thanks. Those are very, very interesting. In terms of the DFIs that we looked at more in depth, public institutional investors were not typically in the ownership structure, except for the Rwanda Development Bank, and I think a couple more, but it was not a widespread phenomena. But I think in terms of the relationship between ownership and capital structure, perhaps IDC is an example of the fact that not because the ownership is structured in a certain way, it means that the DFI is going to receive equity finance from that ownership. Of course, that doesn't mean, there are implications for the governance of the DFI and so on. But in terms of financing, I think it's important to look into not just the structure, but also what is the relationship and how is that mediated in each specific case. The comment on the asset base is really on point. There's been research showing that DFIs in the global south have access to not just the scale of financing they can access is restricted, but also the type of financing they can access. And that means financing through issuing bonds, for example, in the private market. And that is another layer of difficulty. And that means that, yes, in a sense, the asset base is smaller in scale as a result, and there's a feedback look into small asset base, a small portfolio, and therefore the strength of the organization as such. But let me just conclude by saying that the comment was on the scale of financing, and we are also trying to emphasize the type of financing that they receive and how the different types of financing that they receive can condition the instruments that they can use and therefore meet different needs.
Thank you. Thank you. Very, very helpful. And next up, I'm going to look at Sifiso's questions. So Sifiso, and this I'm going to direct to you, Diana. Sifiso asks, can DFIs be leveraged to revitalize sector-specific infrastructure? Not sure what revitalize means, but I'm assuming there is the infrastructure, the capacity building, a whole lot goes into that. If so, what can be done, or which instruments would be appropriate to do so? So Diana, from your experience, can you think of any international examples that have got this right, and which stand out as potentially being helpful from a South African context?
Yeah, it's an interesting question because, I mean, we can think, I'm interpreting the word infrastructure as more like the entire system, the support system behind the industrialization or the revitalization. So if you think about, well, let me use an example from Canada. Canada looked at the whole commercialization continuum and thought, I think, quite deeply about where the funding needs were across through to, full commercialization, which for Canada meant export. So the role that was seen within each of the steps of commercialization of the financial system, particularly when it came to sustainable development or clean technology, they realized there was a gap, quite a significant gap, that many ideas died on the way to the marketplace because there was no funding mechanism to bridge towards an Exim Bank, which Canada has a very significant Exim Bank, and I will talk about that perhaps later for South Africa. And so that sort of the stage of demonstration through to pilot was something that wasn't well funded, and so they introduced something called Sustainable Development Canada, which was a technology function that allowed for repayable grants. So the point at which it was now, this is pre-revenue, it's now revenue generating, those grants were paid back, and it was now a circular funding mechanism. To the point about South Africa, if you've got your industrial policy, which I know there's strong linkages throughout, what I'm not clear about, so I'm coming at this as not very knowledgeable about how it all works within your system. Are there gaps within the funding at all stages? So IDC is doing a fantastic job, really well integrated vertically within your government system, well integrated within other financing mechanisms. But when we look at the demand for financing through the commercialization continuum, how well developed is it? And if we think about the many of these industrialized, or let's say the manufacturing firms are meant to be export focused, export oriented. In South Africa, you have an export credit agency, ECICSA, which is an insurance company which takes export credit risks. Typically, those insurance facilities or guarantee facilities are reactive. They are not proactive. They're not able to, quote, make something happen that otherwise wouldn't happen. We're an Exim Bank, and I know that's been on the topic of the government for some years. I've seen it come and disappear, and I don't know where things stand. Maybe it's, I would think I read a bulletin from ECICSA recently that said that it's now back on the table for discussion. But it is a really important instrument in, again, that commercialization continuum, where if you are born as a company to export, this kind of facility is really important. So I put that more as a question back to my South African friends here. Is that an instrument that could be helpful for South Africa? And is that pre-revenue phase, is that being properly funded so that you really have a full spectrum?
Thank you so much. I'm going to direct that over to you, Pamela. What are your thoughts in response to that?
Sure. On the last point around, the pre-revenue phase. So the IDC has a project development unit whose sole purpose is to fund, pre-feasibility studies, feasibility studies as really early stage investments. And this is all pre-revenue. And this is because we recognize that that's where the biggest gap is from a funding perspective. Because if you think about some of these transition investments that we're looking at, just as an example, but others as well, there's a lot of that early stage work that needs to take place before we can get to the bankability stage. So the department has been around since 2020, but the project development has been happening in different forms within the organization for a lot longer than that. And there, the thinking has to be completely different. So what the IDC does is take equity in these businesses, right? And then walk with the client or the project. And then at the time that it hits bankability, then we can rethink about, are we going to step out? Do we continue? And what is required and necessary for the project to be successful? And this is not something that's typically available at DFIs, and really something that is really crucial and important.
Thank you so much. And in the interests of time, thank you to all the questions in the Q&A. They have really been fascinating and a really stimulating conversation. Annie, what are your thoughts from the conversation? Anything further?
Thanks very much. I'm reflecting really on how serious financing through DFIs is. Very, very serious business. And unfortunately, it just doesn't leave a lot of room for the smaller businesses and for women-owned businesses who are struggling, despite the efforts by DFIs such as IDC to put in a lot of funding into pre-feasibility studies, to enhance the bankability of many of these organizations. They're really often very small when they're women-owned because they haven't been given the kind of support that they've needed in the past. So we've got a lot of catching up to do. And I think I really enjoyed Michael's example of the finance minister. I think that just completely exemplified where we're at when it comes to gender, because as soon as you get into a position of power, as fervent as you might be about the whole value chain and being inclusive, at the end of the day, it comes down to what's going to make the most money, what's going to be the most backable, where are we going to get the most finance? And it doesn't necessarily look at how can we develop our society in totality. And that's a real shame. So I think we've got to go back a few steps, get some businesses going, get them up and running so that they can start accessing some of these DFIs. And I'm not sure the finance from DFIs, and I'm not really sure that's a role that DFIs can play. I think it's going to be the smaller banks and institutions that will have to play that role, and we need to push them to do more of that going forward. And just to make one last point, we have something called the Just Energy Transition in South Africa. And as Michael very ably pointed out, this was about taking the coal-fueled plants and turning them into renewable energy plants. And the Just Energy Transition is about taking all the people who are in the coal-fueled plants into the renewable energy sector. And guess what? Most of them are men. So it's not a particularly just energy transition. So this is a very difficult subject, industrialization, mineralization. It's a tricky one, especially from a gender perspective. Thanks.
Thank you so much. And in the interest of time, I'm going to look at getting some closing comments from each of you. Thank you. These have been really, really wonderful comments and discussion. So what I would like to ask you is, okay, so before I go there, we've touched on how there's no silver bullet. Michael has also said South Africa is not unique, along with EMDEs and other more advanced economies. We've talked about the importance of governance. We've talked about defining risk as a function of rebuilding capacity and productive investment. We have looked at the importance of having flexible mandates and the importance of targeted industries. So if we could look at just focusing on one, if we could look at one policy bit of advice we could implement tomorrow. So if I were to ask you to implement one reform tomorrow to make South Africa's finance system more catalytic, what would it be? So let me start off with the Prof. Andreoni. One thing, if we could implement it tomorrow.
To be honest, I mean, I think most of the discussion has been about how no one single solution will solve the problem. But of course, Pamela pointed out how IDC has been capitalized 75 years ago. Probably it's time for thinking seriously about recapitalization and creating conditions for being more active. But give me just 30 seconds to react to something which I think it can be a problematic characterization of the debate. I've heard that, you know, we have a bias towards old industrial policy thinking. Actually, at the moment in South Africa, the debate is a different one. People have been emphasizing that the country should give up its ambition to transform its economy, that fundamentally is going to be about a future service economy, and small, medium enterprises are more inclusive and so on. So we have to be very, very careful about the narratives that are circulating. The economy of the everyday life, if we think about hospitals, if we think about sectors that are critical to have an inclusive society, these are extremely technology, material intensive sectors that require either we assume that the South African economy will depend on importing these technologies, these things from somewhere else, or we need to think about how to build up these capabilities in the country. I don't think South Africa want to be again in the situation it was during the pandemic. If we think about the example of Brazil, it's not simply about progressive policy, a progressive policy that understands the importance of having an ecosystem that is healthy. And this idea of this dichotomy between large and small, I'm sorry, but it's very problematic. I'm completely with you. We need to regulate, control, use large-scale operation for the benefit of the economy. And I think that's at the core of an agenda, but we cannot give up to have them in the economy, because lots of the small, medium enterprises, I see comments from also Shingi Kisoro, who has worked in CRED or still in CRED on issues related, for example, to sectors where also women are significantly involved, which is related to the agro-food industry. These are, and high-value agriculture, these are sectors where technologies are needed, when we need to have ecosystem where small, medium enterprises are able to capture the value that they generate. And in many cases, the routes to market are also mediated with larger players. So we need to be careful in structuring a narrative which might actually reinforce, paradoxically, positions that have been conservative in the South African economy and do not want to address the fundamental power concentration in these industries that have to be transformed, including the just energy transition. Just energy transition is not just about coal. This has been a fixation that is all about all this. Of course, it's been a fixation for a political point of view because there were influential people in government who had significant constituencies in these specific areas. But if we want to build up a renewable energy system, there are opportunities for different types of players to get involved. The problem is that, of course, as it was probably in the UK, not necessarily people in the coal mines want to move to this sector. So you need to create conditions in these regions to transform the opportunity that are there into concrete opportunity for jobs. And in a way, we need to be open to the fact that the government needs to be able also to create pathways for exiting from certain activities that will require time to emerge. I mean, successful countries have not just crunched and moved people from one activity to another, have allowed recession cartels, mechanism to smooth the transition and make it more socially just and acceptable.
Thank you. Okay, Pamela, closing thoughts.
Thanks very much. And I'd like to build a little bit on what Antonio has just said, and perhaps I can start where he left off in terms of the just energy transition. So what the IDC has done, and I believe done very well, is that within the context and that conversation, we have advocated very hard for the productive aspects of the transition. So looking at just the International Partnership Group funding, we advocated for the inclusion of green hydrogen and new energy vehicles, which was very difficult. And it's a small portion of the total funding that is available. But what that will do is that it will support continued jobs as well as wealth creation opportunities through entrepreneurship in terms of businesses. And this, we were very deliberate about it, and we continue to be, and we are continuing to mobilize funding around this. So the first grant that we received for green hydrogen, which came from KfW, we actually, our first client was a woman-owned business that's going to produce ammonia and e-methanol. I hear the point that Annie is making, and I take it into account. It's something that the IDC is working towards. So this is what we're doing. We've got a pre-investment unit, which is targeted at supporting particularly small businesses to be able to, to apply for funding and understand some of the other issues. As part of that, we've got a program called SME Connect, where we connect our clients or potential clients with large firms. This is, because now you're creating a source of demand which supports the sustainability of those businesses. And as Antonio indicated, we do recognize that women have not featured so prominently in industrialization. But if we are to change that going forward, we still need to continue to fund that. So looking at our financing from last year, about 35% of our funding went to women-empowered businesses. We need to do more to support that, but certainly there is some progress that's being made. Then at a more general point, I wanted to just highlight just how much we've thought about bringing together economic resilience and sustained economic growth with sustainability from an environmental perspective, as well as inclusion. And this has underpinned with a theory of change that stems from structural change. So both sectoral deepening as well as sectoral transitioning, the pathways that we've identified for South Africa's sustainable industrialization. I spoke about diversification as one of the pathways, as well as the low carbon and green growth. So on diversification, what we are pushing for is moving down value chains. Now, the further down value chains you move, typically not always the case, there's more opportunity for employment creation, and there's more opportunity for entrepreneurs to be able to come in. It's not as capital intensive, for instance, right? So this really does support the inclusion element. So it's not something that we recognize as a side, but it is a core part of our pathways. Then even with something like the low carbon and green growth pathway, we have, based on work that was done with Antonio Andreoni, Simon Roberts, and others, developed an integrated system of how do we link investments in renewable energy with the component suppliers, with then linking up with the industries that will use that energy. How do we ensure that we don't only transition the upstream elements of the value chains, but also the downstream, so that they can continue to be competitive both in the domestic and in international markets? We do know that global demand patterns are changing. And so we need to think about how do we sustain the capacity that we have, as well as add on new capacity in that regard. Then maybe briefly around the issue of the shift towards services. So no one disputes that services are important. We must also recognize that some of the services that exist were outsourced from industry, right? So that link between industry and the services remains quite important. I mean, there was an exercise that was being done, and one of the presentations highlighted that South Africa should be focusing on finance services. We've done analysis around the potential for finance services in South Africa to generate jobs and particularly support inclusion. And it's quite clear that gross value addition goes up because there are a lot of highly paid people. But in terms of job creation, it's simply not as strong. And some of the research that underpins this thinking around the shift to services as the driver of growth was undertaken in developed countries. And in a developing country context, can't just be transposed. So we need to think about, in our context, what do we need? We do know, yes, from some of the older literature, but we've thought about it in the current context, that before an economy transitions into services, that's a key driver, right? It needs to reach upper middle income status. South Africa is far from that. And in fact, in terms of our per capita GDP, we are declining. So shifting towards services, or moving full on to services before that point, makes vulnerabilities in the economy. And this is because some of the particularly high value services require there to be industries. So South Africa is very good at some of the services related to mining. But the reason for that is because we've got a mining industry. So if we don't have those industries in South Africa to develop the services capabilities, then our ability or our capabilities in those services would decline in any event over time. Then briefly on the question that you asked, I think one of the reform, definitely not a silver bullet, that could assist is, for instance, exempting the IDC from paying tax, right? What that simple change would do is it would allow us to mobilize grants, particularly from international organizations, that we can use either to blend financing or to provide directly, depending on the instruments that would be required. Thanks.
Thank you so much. Very, very powerful. Right, who's next? Adria, closing comments.
Hi, thanks. Yeah, just very quickly, I take again the global, the continental perspective. I think that it has been emphasized how important it is to look at the different ways of meeting the same function. In that case, it is about financing industry, financing industrialization, and how that can take different forms. I just wanted to highlight, of course, the degree of change, institutional change, is path dependent, is very contextual, but taking a step back in relation to some of the comments made on the potential implications for pension funds engaging in investment and how that would affect their own credit ratings and so on. Just to bring to the fore the case of a CDG in Morocco, which is effectively combining savings from social security, pension funds, and so on. It also has a banking element, a banking branch, so it effectively also operates as a bank. It invests as a sort of in state holding investments, large-scale strategic investments, and then it also makes small investments. And of course, I'm not saying this should be the model, but that is something to consider, where different instruments are blended in one organization, which is 35 billion in assets, is 24% of the country, and that is an example of different types of instruments that can come together into a different structure.
Very helpful. Thank you. Over to you, Diana. Closing thoughts.
Very quickly, I mentioned the Exim Bank. My question is also about an SME bank. SME banks across the globe that are very focused on small business. What are the needs? They're very focused on women entrepreneurship. I think what Pamela's described at IDC is excellent, and core to your business, and that connection I think is really critical. But many countries have a bespoke SME development bank, unless they're a band ass and they're all singing, all dancing. But here in South Africa, you've got the IDC, you've got DBSA. We mentioned the Exim Bank. So my question, and I'm not even advocating this because it's not about a proliferation of institutions, but it's making sure there is enough focus on that one segment.
Thank you. Thank you. Over to you, Michael. Closing thoughts.
Thank you. And I'm very glad I've inadvertently stimulated Pamela to give that extremely clear and incisive analysis of the industrialization path for South Africa and in particular. I was not trying to say, just to be clear, that that industrial policy should no longer focus on traditional industries or on manufacturing or on exports, on all of those things, and should suddenly switch to only service sectors. I wasn't saying that at all. And I wasn't commenting on the debate in South Africa. I was commenting on a debate particularly in the UK, about the focus of industrial policy, and that it needs to be diversified from the narrative that some people have in their minds, which is particular sectors. And Pamela is absolutely right and has explained it very clearly about the interlinkages between different kinds of companies, which is partly about company structure, and the importance of anchor industries, particularly mining and manufacturing, and so on in South Africa's own industrial path, and that's true across the rest of the continent. So if I was the target of some of the remarks, I wasn't saying that, but I'm very glad that I stimulated that very clear explanation from Pamela, which I would agree with. And it's impressive what IDC is doing and IDC's analysis. My one recommendation, I am not arrogant enough to make a recommendation to South Africa from I'm actually in Washington at the moment, but from outside, except to welcome people from other countries and to help you think this through, because South Africa is not unique. There are institutions which have been trying to do this, are grappling with the same issues, grappling with the same just transition issues now in Latin America, in Asia, countries which have gotten further towards the model of industrial kind of becoming upper middle income countries, and there is a lot of expertise, and there is expertise and experience in the African continent as well. South Africa, if I may say this, doesn't always look to other African countries for lessons, but there is a lot of experience out there. And Canada's pension funds, as Dana will know, are more engaged in this debate than many pension funds. So there's lots of experience elsewhere, and I hope that South Africa will invite it in and learn from it.
Thank you. Right, last but not least, Annie.
Sorry, I don't know why the audio was not coming off. Thank you so much. And thank you, Michael, for taking all the blame. I thought it was my controversial comment about how so little gender is talked about in these conversations. So I think it was both of us. And I was very, very excited by what I heard from Pamela. And I've already written to her in the chat and said, please write this up. We need this. Because I've done a lot of work with various people in IDC, and I know how passionate they are about this. And I'm not at all feeling that we're doing nothing, but we can, of course, do more. So thank you.
Thank you so much. And on that point of passion, thank you all for being such a passionate panel. I have thoroughly enjoyed this conversation and this debate. And I could certainly go on for a lot longer. So I do suggest that everybody contacts us if they've got any questions and would like access to this. We will be putting this on our website, the ERSA website, as well as the ERSA YouTube channel. And all the resources can also be found there, so we can direct you there. Thank you so much. Thank you to all of you. I really appreciate, and ERSA and the IEP program, we're very, very grateful for your attendance, especially those in the Vancouver and Washington time zones, wherever, whatever the time is now. And thank you so much for all your passion and deep insight. Really appreciate it.